The UK economy is stalling. There's even talk of stagflation, which combines poor growth with rising prices. In this video, we'll dig into the numbers to see the state of the economy right now, but also peel away some of the doom and gloom narrative to reveal some reasons for optimism. Today's video is sponsored by Trading212, a UK commission-free investment platform. So is the UK economy stalling? Certainly if we compare it to the United States, you can see that the UK has almost flatlined relative to an economy that's doing really well like the US. Relative to where we were in 2018, the UK is up only about 5%, whereas the US is up almost 17%. So when we see headlines like this, which shows that UK growth was plus 0.1%, it's hardly cause for celebration. Now GDP is backward looking, so it's always interesting to look at other measures like PMI surveys, but also things like confidence indicators for households and businesses. And if you do that for the UK right now, it doesn't paint a pretty picture either. Now this is survey based. Lots of companies are asked whether they think things are going to improve. Do you think you'll be producing more output over the coming year? And that covers the manufacturing, services and construction sectors. Now just after the election, that hit a 2-year high, but after Labour pretty much talked down the economy, that fell quite sharply. Sentiment amongst consumers was similar. It surged after the election, and since then it's slumped. Perhaps even more worrying, if you look at the blue line on this graph, the one that's falling sharply, that's the consumers' attitudes in the UK towards making major purchases. Now that fell very sharply in January. In fact, if you exclude the pandemic period, that's amongst the lowest willingness to make major purchases that we've seen since July 2012. And that was during the height of austerity and the European debt crisis. Now, before we get on to the more positive outlook, I'd say there's one more thing which worries me quite a lot about the UK economy, which is that growth is simply not a priority. Now, this was captured beautifully in an article in the FT by Janan Ganesh. And the title of the article was that Britain should stop pretending it wants more economic growth. And he makes the point that whereas in the US, growth is the most important set of policies, that overrides every other consideration. Whereas in the UK, it doesn't matter what political party you look at, growth isn't so important. And as he says in the article, Tories want growth, but not if it means building things aligning with Europe or much exposure to China. Labour wants growth, but not if it incommodes the unions or leaves people behind. Now, one of the things that the Labour government has promised is that planning permission will be much easier to get in the UK now. However, if you look at this story about a film studio, which is in my neck of the woods in Marlow, it was all looking quite positive. And remember, this is a big export for the UK. James Cameron was behind it, and so were large portions of the UK film industry. But it wasn't particularly surprising that the plans got rejected. This was going to be built on Greenbelt land, and as far as the Buckinghamshire Strategic Sites Committee were concerned, this was a no-no. And this has all sorts of consequences. For example, if you look at energy costs for electricity in the UK, it's the highest in almost every other developed country. And the UK has not built a nuclear power station since 1995. Plus, if we want to expand the grid to have more electric vehicles, there are going to have to be lots more pylons, which nobody likes. Again, we want growth, but not if X, Y, and Z. These priorities have got to change if we're serious about growth. And I'm not convinced that either political party are willing to make those sacrifices. Now, before we go on to talk about the more positive things about the UK economy, today's video is sponsored by Trading212, a UK commission-free investment platform, and I've been using it for my fund portfolio for some time. And there are lots of features I love about the platform. I can have a portfolio of single stocks, which I can rebalance with the click of a button, and that's using a feature called a pie. It's like a portfolio within a portfolio. What's more, I can publish that pie so that other people can see it, or I can look at other people's pies to get inspiration for my own portfolio. And some of those pies are published by professional fund managers. Now, what does zero commission mean? Well, it means you don't have to pay for trades, other than the usual difference between the buying and selling prices for stocks. But most impressive is that there's no platform fee. It's zero. You do have to pay a 0.15% conversion commission if you convert your currency from sterling to another currency. Now you might think low fees means not very good features, but that's not true at all. Those low fees come with some great features, such as trading Autoinvest. So that's a multi-currency account that allows you to hold money in multiple currencies. That's great because you don't have to convert money back and forth every time you choose to buy, say, US stocks. The Trading 212 card lets you spend the uninvested cash in your invest account, that's your general investment account, not your ISA, and you can earn 0.5% cash back on your spending up to a limit of £20 a month. And if you use that card abroad, Trading 212 has actually waived their FX fee, that 0.15%, and you can make use of their very competitive currency conversion rates with no spread markup at all. And you can spend in 13 major currencies. You'll also earn competitive interest rates on the cash in those currencies, and the ATM withdrawals are free. There are no monthly fees or subscription plans. You just pay $4.95 up front to get the physical card. Now, viewers of PensionCraft have a special offer from Trading 212. You can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, and then use my name as the promo code, which is RAMIN, RAMIN, and you'll find a link to that offer in the description below. Now moving on to the more positive things, let's talk about tariffs. Now I said that was possibly bad. Why is that? Well, we do export a lot to the US, which is going to be imposing tariffs across all of its trade partners by the sound of it. And the US is the single country to which we export most. It makes up about 13% of our exports. Now exports make up about a third of GDP, so even if we were to have US exports go to zero, it would only knock about 4 percentage points off our total GDP. But if we look at US exports and break it down by country, you can see that we only make up about 4% of US exports. So fortunately, we may fly under the radar because the US doesn't export much to us. It's much more likely to focus on countries like Canada, Mexico, China, and Japan, with which it trades much more. Also, if you break down our actual exports to the United States, a lot of it is in the form of services. So we do have a services surplus to the United States. So in 2024, we exported about £130 billion worth to the US, and we imported about £62 billion. And the focus of tariffs seems to be to do with manufactured goods. So again, maybe we'll fly under the radar. That can't be said of the rest of Europe. So while this isn't an absolute positive, I think it's the lack of a negative. Now let's get on to the good stuff, starting with low unemployment. And unemployment in the UK at about 4.4% is really low. You'd have to go all the way back to 1974 to see something that was comparable. Now low unemployment is good because it means that most of us can find a job fairly easily. And that's good for growth, it's good for disposable income, it makes us more likely to spend if we're confident about being able to find a job. Another positive that kind of goes with that is good real wage growth in the UK. And again, compared to history, we're in a pretty strong position right now. If you subtract inflation from wages, you can see that it's got a fairly brisk growth rate at the moment. So total pay in real terms is growing by almost 2% per year. And this is making households better off. Now you don't want too much wage growth, otherwise that can be very inflationary, and that is one reason why the Bank of England says that services inflation is sticky at the moment. But it does seem to be abating, so it's not bad enough to be hugely inflationary, but it's good enough so that we earn more in real terms. And inflation itself is falling. So if we look at the December inflation number, it fell to 2.5% per year, down from 2.6% the previous month. And that surprised economists. Now, given the weak growth and falling inflation, traders are now pricing in a roughly 80% chance of a 0.25% interest rate cut in February, whereas before we saw this lower inflation number, that probability was just 60%. So hand in hand with lower inflation will come lower interest rates, which is good news for UK borrowers. And finally, despite all of this doom and gloom, the FTSE 100 is at an all-time high. Now there are lots of reasons for this. Globally, risk appetite is high and that tends to drag up the UK market with the rest of the world. Those inflation numbers are falling, Lower interest rates is generally good for stocks. Plus in the UK we've seen something new, which is buybacks. We don't usually see that in the UK. It's good for shareholders. And of course, certainly for the FTSE 100, remember that it exports a lot. A lot of these are multinational companies, and when sterling weakens, that tends to flatter their earnings when they're converted back into sterling. So certainly for UK investors, this has been a good time, even though economically we see very little growth. So while I think almost all of the narrative you see in the news is about economic woes and gloom and doom, I think actually the case for the UK isn't so bad. If we do get those reforms in planning permission, it could be transformative. However, and there's a big but here, which is that it'll take a long time, probably beyond the end of this parliament. And frankly, I'm not convinced that the UK is going to be patient when it comes to waiting for that growth to appear. But I certainly don't think we're seeing a state of stagflation. It is the case that inflation's currently falling, and that's good news for the UK economy. So stag, yes, inflation, not really. And I think the outlook is actually looking okay. Now don't forget the offer from the sponsor of today's video, Trading 212. As a viewer of Pensioncraft, you can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, and then use my name as the promo code, which is Ramin, R-A-M-I-N, and you'll find a link to that in the description below. And, as always, thank you for listening.